What's happening all is Friday the 18th, getting a little bit of a later start today because I want to gather a little bit more data to kind of go over some things and see how the market was going to open definitively this morning before I got too far and stuff. But before we get too far, got to go back to that link, very beginning of this time, the Confident Investor Summit. Going to be talking there on the 21st with respect to, I think it's at 9:45 a.m. Pacific. Got to look at the schedule there, 10:45 Mountain, 11:45 Central, 12:45 p.m., right? Just afternoon, Eastern. So got to look at that, go to the link, subscribe to that, or sign up, whatever you got to do, jump on there, take a look. I'm going to go deeper, a little bit deeper into some of the inflationary stuff, get some amortization charts out, talk about interest rates and how they sucker people in. Because, I mean, I've got, right now, think about this, right? The market doing what it's doing. It's ugly out there compared to what we've had. Is it really ugly compared to what's going on out there in greater scope? I mean, let's consider where we are, right? So we have interest rates definitively in the fives right now. And there are some people, some situations where points are being charged. It's not something we can get away with. It's not something we're charging. It's something the market is charging. Let's talk about why, right? Why would there be points being charged today at these higher interest rates? Where are we at with inflation in reality, right? We're 8% plus in the CPI, right? We're talking about, now that's the BS metric, right? You look at the real rate of inflation is over 16%. Would you lend your money out for 30 years at 5% right now? Hell no, you would not. I wouldn't, right? I've done hard money deals. I've done as low as 9% and 2 points, but I knew that person was going to pay off in a year. Look at the CPI. Even at the CPI 8%, I'm making 1% of my money. That's nothing. The 2 points is helping me out. So I'm making 3%. Big deal. 3% of my money is not worth it, right? But it was a friend. So I did that, right? I'm making more than that having it somewhere else. So when you start looking at that, having somebody willing to give you money, let's say even 5.25 and chart, and right now they are charging a point or two. Why are they doing that? Why would there be points being charged right now? They've got to attract money in there somehow, guys. They got to get people to be willing to put that money up. How do you get them to be willing to put that money? You pay them a little bit something up front. They're going to look at this thinking, okay, well, the people are refinancing in the first 4 or 5 years. So I at least get a couple points up front. At least gives me something to work with here, right? Plus, there's also a risk that people are refinancing if the market flips the other direction. We don't know if it's gonna, right? But if it does, if something happens as it flips the other direction and goes back, which it could, and if it did do that, people are going to get back on the refi train again, right? If they did that, anybody who put their money up is going to lose big because they put all that money in. They pay out about $4,000 on the average, as I understand, from when the money leaves the bond pool, trickles its way through auditors and all that kind of stuff to the lender, to you, the consumer, to close on that transaction. Then it goes back and goes through various forms of audit and review and all that stuff to go back and securitize that paper. So got to make sure the paper fit. Right? Just because they gave you the money, it doesn't say it's all over with right now. They still have to look at it and make sure everything was done right before they're able to put that out there and sell it back on the market. So they got to make sure the product's good. It's a lot of money spent. And the only way to make that money back is with interest being paid. And what are they paying in interest? You're paying 5 and say, let's just call it 5.25 today. I'm not quoting a rate whatsoever. This is not the rate you could expect. I'm just throwing a number out there. As a real estate investor, let's say that's what it is. Are they making money very much? Hell no, they're not. You're winning in this. So what's the benefit to you of it being going higher? Yesterday, I had somebody shoot an email off, say, hey, can we talk about this cost situation? They didn't give me a chance to talk to them, right? They literally sent another back, saying, what? We're just pulling out of the deal because it's too expensive. Case in point, what I've been saying all along, people that don't understand what they're doing, that are novices in the market, are going to walk away. And when they walk away, the more confident investor that understands this, because we've been talking about this so much, and you have the tools, you have my app, you all those things, you're going to be able to move forward and say, I'm taking that deal because I know it's not about this year, and it's not about next year. It's about 3, 4, 5 years from now when I'm going to get that domino of growth, right? So know that people are walking away from deals now, and they're doing it out of ignorance because they don't know what you know. Let's talk about some other things you don't know right now. I'm going to go ahead and share some stuff in the market. Here is the 10-year note, the 10-year treasury, right? A lot of people tend to go to the 10-year treasury to look at that and see as a measurement of what the bonds are doing, because it's the largest bond out there, really. And they're using it as a measurement. So, okay, a rate's going to go up or go down. So as this goes up, the rates go up. As this go down, rates go down. if things are tracking in the same direction. This is showing bond yields, money going into it, therefore bonds, actually money coming out of there for bond yields are increasing. Well, basically, it's just, I'm not going to confuse you with any of that. As this goes up, rates pretty much would follow suit as going up. Look, if you look at this channel was built out by a gentleman that released this out in the last 24 hours. This channel goes all the way back to the 1980s. And you can see it's worked within this channel. You know, this being higher, meaning rates were much higher in the 80s, right? And it's being lower, rates are much lower now. If you follow this channel, we just reached ourselves a peak. We may be going back down into the bottom of this channel. So interestingly enough, if it went to that channel, right, we should see if it's peaking out, that maybe the market might be turning a different direction. So here's our mortgage-backed securities. We're looking at the 3.5 coupon, which is what I'm focusing on right now. Look at where we hit this bottom. Now we're starting to come back. Now, we've done this several times. I'm not saying this is it, right? We've hit this a couple times, and look, hell, right here, it looked like we might have definitively found that, but it was going back too fast, too many gap ups, right? It means it was more of an emotional move, in my opinion. This one, they're tight. We might see this move slowly up as the other starts to move slowly down, right? So when this one starts to move slowly down, we might see the other one going up. Therefore, if the mortgage-backed security is going up and the treasury is going down, we should see, hopefully, interest rates start to improve. I can't say that's going to improve. Everything that we've been talking about in the last little bit, thinking that maybe things would improve and that this was the point, and you're looking at that chart and it didn't do that. So it's pure speculation at this point, but we at least seen some correlation, right? Hit the peak on one end, what looks like a potential bottom on the other. We might have a little bit of reprieve. I don't know that we're going to get a rate reprieve. We might get a little bit of a point reprieve coming forward, but you just know there's a benefit to this. There's a cost to everything, right? This is what you're going to do to attract people to be willing to give you money for 30 years. So don't discount the situation, and don't discount the fact that it's going to scare others off that don't have the guts to stay in it. Another thing here, something especially people in California you need to be aware of, this new bill popped out here that would impose a 25% capital gains tax on anything you flip when you've owned it for basically just 3 years. Anything less than 3 years is what I'm gathering here. 25% just to the state, guys. Raise hell about this. I know they tried this crap in New York. It got shut down. I'm part of where I got this information. I'm part of it, somewhat of a delegation, if you will, the group of people. I've been to DC with them in the past. Where they see these things, they alert us to get this out there and let people know. If you're there, don't let this go on. And reason being, even if you're, and I think this might be a way they're trying to get people not to exit or what they're trying to do here. I can't speak to what the intention is behind it. But if one state starts, other states might think that the rest of the people in the states are dumb enough to do the same thing. Don't let it even start. Stand up, raise hell. 25% to the state because they're mismanaging everything is not, that doesn't make sense to me. So you make your own conclusions. I'm just pointing it out there, putting it out there, letting you guys know that it's there, be aware of it, and go out there and stir up some stuff right into people that are telling them you ain't standing for that. Especially, I mean, think about that. You bought a house, and especially with the way things grew this last couple of years, hell, you could see a house double. I mean, potentially, right? You bought something for $1 million, sell it for $2 million. It's $250,000 in taxes right there just to the state. So think about that. Appreciate you guys. Remember, go to the beginning. Go to the email, click on that, the Confident Investor Summit. I'm going to be talking a lot about inflation. We talked a lot about amortization tables, talk a lot about where you're being taken advantage of when you really focus on interest rate to the extent that you end up putting yourself into a rat wheel that ends up just putting you in financial servitude, if you will. So I want to make sure that we hit on that pretty heavily. Appreciate you guys tuning in, and I'll bring you more data on Tuesday.